Australia's relationship with China remains at the centre of foreign policy. One of the more complex areas is trade, as despite regional and political tensions, China remains Australia's largest two-way trading partner by a long way and the sixth largest source of direct foreign investment. There's discussion today around how both nations are looking at diversifying their trade bases away from one another. Let's get some analysis with Shiro Armstrong, a professor at ANU. He's the director of the Japan-Australia Research Centre and the Asian Bureau of Economic Research. Shiro, thanks so much for your time. This idea of decoupling let's start with the US and China economies. There's been a lot of talk about decoupling. It doesn't seem to be happening.
Yeah.
The economies are still very tightly linked.
Thanks for having me on, Kieran. That's right. Trade between China and the United States continues to grow, both directions, and US investment continues to pour into China to the tune of about $33 billion or so just last year. And that's a significant commitment from American businesses. Despite the decoupling in sort of the policies and the rhetoric, especially in high-tech areas, around sanctions on Huawei and other high-tech areas, the investment continues, and it continues across the board, really, into retail, into manufacturing in China. And so some of the high-end tech investment may have slowed, but it hasn't completely stopped either. A lot of US companies are getting exemptions from some of these sanctions.
So American companies expanding their operations in China by over $30 billion last year. It seems at odds with the geopolitical equation. What's going on there?
Well, in one sense, it complicates the geopolitical situation, but it's a reality. The economic relationship is large and it's growing. And that's what makes it completely different from the Soviet Union and the United States during the Cold War, where there was no economic interdependence or relationship. Here, they're locked into each other, and that is only growing. And you think about that US investment into China, it's much more than arm's length trade, which is just contracts that you can shift over time. We're talking about setting up factories, setting up businesses in China. And for this to be happening last year when China has, got closed borders and pursuing a zero COVID strategy, I think is quite significant.
And I think you touched on it earlier, but just to elaborate in terms of the breadth of the trade relationship between the US and China, because we think about our trade relationship, as I mentioned, largest trading partner, but a lot of it is resources.
Yeah.
That's not the case with the US trade relationship. It's more diversified.
Yeah, so China used to be the factory of the world, and a lot of investment going in to produce iPhones, cars, electronics, all sorts of things. It's shifting now to be the market of the world. Not quite as large as the US market, but that middle class in China is large and growing. So companies are shifting into China to sell to the domestic economy, not just to manufacture and sell back to the United States.
And you see that continuing despite the tensions we've seen around Taiwan, particularly?
I think so. It'll take a lot more than some wobbles in the geopolitical relationship to stop this trend. These companies are already locked in. We're talking about huge stocks of foreign investment, already the big business presence there. And these companies are hiring local staff, developing IP and feeding into networks in East Asia for production. So it's really, again, beyond the arm's length trade, a real commitment to doing business in the Chinese economy.
And as you've written today in the newspaper, it binds them together. And that parallel with the Cold War is interesting because there's really no parallel, is there, in the sense that the tensions, yes, but in the Cold War, there were no real common interests. The only one was not to destroy each other.
Not to destroy each other. Now there's a huge shared interest in managing that large relationship. There's a huge shared interest in the transition to net zero emissions and managing climate change. So it's a difficult relationship. The Chinese sanctions on Australia, Chinese intervening in markets creates all sorts of uncertainty, and it's not where we want to be and not where we want the Chinese economy to be. But I think the starting point is to recognise that that's a reality. It's the world's largest trader and only becoming bigger. And I think some Japanese businesses, it's the same with some American, but they really see the risk in engaging with China is to not engage. Their business risk is to keep a distance from China. So they'll lose to their competitors if they're not in the Chinese market. That's how important
you've pointed out as well that on the Australia-China relationship, it's not just us seeking to diversify, which hasn't really happened, but the Chinese as well, in terms of where they get their resources, iron ore and so on.
Yeah, well, putting a lot of money into Western African iron ore and developing iron ore out of Western Africa as insurance, as to diversify their supplies. So it's a bit of a strange situation when you've got both countries trying to diversify away from each other. And so far, we've not been that successful. And I think that's probably a good thing because it'll be very costly if we have been successful, if we are successful at reducing trade shares with China. Japan is continuing to build its economic relationship with China and all of our neighbours. So if we try to reduce that dependence on the Chinese, interdependence with the Chinese economy, what does that do for our engagement with the rest of the region, the most dynamic part of the global economy?
Shiro, Professor Armstrong, thanks for your time.
Thanks, Kieran.